evening, everyone. So today the topic of discussion is financial modeling. Now, even before I start with the topic, what I want you to understand first is that many of you coming from different background, science background, commerce background, and so on. So first I lay the foundation that what is financial modeling. So financial modeling is where, say for example, there is a company and the company is doing good or bad. We want to understand. How do we understand about the company? So I'll give you one quick example. All of you are doing your graduation or you have completed your graduation. So if I want to understand the performance of one of the student, what we do is we look at the past data. Maybe your 10th standard, your 12th standard, and your graduation marks. And then we try to foresee that, okay, what could be expected from this student in the future? Or probable. Definitely, it may change. In the same way, when you go to the company for interview or when you go to any MBA college for an admission, what do they see is that what has been the past performance. Why do we see your past performance? Why do we want to know that how were you when you were at your 16 in your 10th standard or your 12th standard? The reason is we need to build up a base, trying to understand that, okay, based on past performance, what can we expect? Absolutely right. Okay, Yashraj, if your workbook is not opening, Google Sheet, just download that sheet. That would become your Excel sheet and then you can start working on that, right? So download it, it will become an Excel sheet so that we can start working on that. So financial modeling is not a standalone thing. We need information from accounts team. Now, do we all understand the meaning of balance sheet, income statement? And if the financial statement of the company is made, which statement is made first? The income or the balance sheet? The income statement, right? And from the income statement, after that, the balance sheet is made. Now, do you think there is a connection between both the sheets? Is there any kind of connection between both the sheets? Yes. So net profit that we take from the income statement, we use that information in the balance sheet. So when I do financial modeling, how the analyst does this is we take the information from accounts. We also use the industry information. Say, for example, yes, profit and loss statement are there. We take from there the net profit and then we use that. So all the statements are interconnected to each other. Profit and loss statement is made, we take the net profit and then we take it to the balance sheet and then we try to understand that what is the performance of the company in the past. And can we also forecast based on past performance the future of the company? Can we project, just like I told you, from your 10th, 12th and graduation marks, we try to project to how you would be performing in your job or in your post-graduation, right? So we need accounts, we need finance. Do I also need an understanding of the business environment? Yes or no? Do I also need to understand? Yes. Why? Why do we need to understand the business environment? Does this give me an information that, okay, how this particular industry is going to perform in the near future? Because I need to make assumptions. Absolutely right. Okay? So financial modeling is consolidation of accounts, finance, and the business information so that we are able to forecast the results of the company. Now, absolutely right, Rishi. So now, when you're doing the financial modeling, so we first try to understand that why are we doing this? Now, the companies may use financial modeling for number of factors. All right, I'm getting a lot of chat regarding can't download the Excel sheet. So in case if somebody has already downloaded, please share that so that everybody else can use that. Maybe you can share with your ma'am and then it can be downloaded. Because if Google Drive it is, you have to just download that sheet and it will become an Excel sheet. If not, you can work on that Google Drive itself. Yes. Okay. Now, why do we use financial modeling? The companies may use financial modeling to understand that, okay, what has been my past performance? What has been my past performance? And what has been my past performance? And based on my past performance, can I forecast the future performance of the company? Does management need to understand that? The answer is yes. Do I need to borrow money or not borrow money? Will I be able to make the payment of the borrowed capital or not? Or companies use this for mergers and acquisitions, finding out the value of the company. Now, just imagine if I have to buy a company, I want to make investment in a company. Wouldn't I want to forecast the future and then see that whether this company in the future, what would be the value, the growth of the company? Will it be important for me? Yes. So that is financial modeling used for forecasting your own financial statement, understanding your own performance, to borrow the money from the market, going for mergers or acquisitions. Everywhere the financial models are used. I'll be going to the sheet soon. I'm just doing a kind of the warm up before we get into the actual sheet now. Do you all understand this concept that there are debentures and equity? Do we understand the difference between the two? Yes. So what is debentures? What is debentures and what is equity? Both are borrowed capital. Debenture holders, the company has an obligation to make the payment in the form of interest. Absolutely right. Whereas equity is that if I start up a company and I issue the shares in the market and all my 502 students make investment, do you become the owners of the company? Yes. Right? You'll become the owners of the company to the extent of number of shares. Fine. Okay. Now I have laid the foundation. You know income statement, you know balance sheet. You know that income statement is made first and then we make the balance sheet and we use the information to forecast the future, maybe to find out the performance of the company, maybe to go for mergers and acquisitions with another company. So even say, for example, like I have worked for JP Morgan Chase. A lot of companies come for mergers and acquisitions. Definitely as an investment banker, JP Morgan would do the valuation of the company. Do you think it's important to find out what is the value per share that has to be paid by one company to the other one? Yes. So income statement is made first because the net profit from income statement is an important information to be carried over to the balance sheet in the form of reserves and surplus or the retained earnings. So we take that information from the income statement and put it in the balance sheet. So that statement is always made first, right? Now let me take you to the Excel sheet. So I hope everyone is ready with this sheet, right? We will understand what it is and then we'll go ahead further, okay? Could some of you download the sheet? Yes. So I'm sure if you can help your friends that how you could download it. So the same way they can download it. Maybe you logged in from a particular ID, IBS, the IMS ID or something. Maybe you can download from that, right? Let me start. So Alpha Limited, which was incorporated on 31st December 2020 with initial capital infusion of 2,24,000 of debt and 3,36,000 of equity, right? So let's understand what does this caselet mean, okay? Even if someone has not downloaded, don't worry. Understand the concept. You can do it later. Right now, you can write down on a Word doc or on an Excel sheet. Don't worry about it. Let's focus on understanding the concept. So it says Alpha Limited incorporated on 31st December 2020 and initial capital was 2,24,000 and 2,24,000 was the debt and 3,36,000 of equity shares. We all know that whenever a company starts operating, they would want the equity and maybe the debt infusion also. And this company was distributor of industrial goods. The company managers immediately invested the initial capital in fixed capital of rupees 5 lakhs and working capital of 60,000. That means whatever money they had, that is the borrowed capital of 3,36,000 plus 2,24,000, they invested in fixed assets in 5 lakhs and working capital 60,000. Now, what is working capital? The working capital is current assets minus current liabilities. But what's the meaning of that? The money that is required for day-to-day expenses is called working capital. Okay. So this was, if you can see here, does this total of 2,20,000 plus 3,36,000, how much is it coming? Check. How much is the total of 2,24,000 plus 3,36,000? Quickly, let's check if we are 5,60,000. So in that 5,60,000, the company invested 5 lakhs in fixed assets and 60,000 in working capital. That is for day-to-day expenses. Working capital initially consists only of inventory. Now, as I'm reading the data, I will also, this is the data that has been sent to me by the management, and I'm the investment banker trying to find out the value of the company. So what will I do is I will simultaneously start putting the data also. Allow me a minute. Yeah. So I'll just take this sheet here and I'll come here. So this company was incorporated in 2020. And very clearly it says that moment it was formed, they had made investment in the fixed assets. How much investment was made in the fixed assets? How much investment was made in the fixed assets? So everything I'm going to write in thousands, so that can I write here 500, the information that has been given? Can I put that as 500,000? So that is equivalent to 500 into 1,000. Is it 5 lakhs rupees? Yes, very good. Now, fixed assets is given to me as 500. And the remaining information, it says that the fixed capital consisted of non-depreciable property of rupees 5,000 and depreciable property of rupees 4,50,000. What does it mean? Can somebody explain what is depreciable and non-depreciable? So depreciation would be charged only on 4,50,000, right? 50,000 could be for land. Wonderful, right? So these are my information given regarding the fixed assets. What is the remaining information given here? They say that 60,000 of working capital, and working capital consisted only of inventory. So inventory would be for how much? 60,000. Absolutely. Okay, so 60,000, I will write only 60 because already I'm writing all the data in thousands so that we don't have to write too many zeros. That's the only reason. Are we good till here? No questions? Okay, great. Another information that I have here is 2,24,000 of debt. Let me put out that information also here. 2,24,000 of debt. So where will I go to the balance sheet? I'll come here and can I see here 2,24,000. So what should I write? 2,24,000 of debt. 2,24,000 of debt. How much is equity? Check. How much is the equity amount that you have it? 3,36,000. So we will put here. We are starting financial year in that, assuming the financial year is just starting. My balance sheet is not visible. Why? Everybody can see my screen clearly? Okay. Now, any other information? So I'm just checking if I put all the information because I need to forecast it. Okay. So Alpha Limited incorporated on 31st December 2020. Initial capital infusion of 2,24,000. We'll do it. And 3,36,000 of equity. Right now, I'm just putting the information which the management has provided to me. And looking at the information, 2,24,000 of debt I have put and 3,36,000 of equity I have put here. The company managers, so when they borrowed this amount, they immediately bought fixed assets of 500 lakhs. That is what we have put here. Fixed assets of 500, that is 5 lakhs or 500,000, and working capital of 60,000. Working capital, what was there? Only inventory was there. They bought only inventory. So we put that 60. Now, what is the information? The fixed capital of 5 lakhs, 50,000 was non-depreciable and 4,50,000 was depreciable. Now, this 4,50,000 property has how many years life? 10 years life. Now, we have to, only this information has been given to me and we have to forecast the financial statement of this company for the 3 years following the incorporation. We will also find out the value of the firm. So say, for example, we are JP Morgan Chase, and this is the information given to me, which I put only 4 informations in the year 2020. Inventory, 60,000, fixed assets, 500,000, which is 5 lakhs, equity shares, 3,36,000, and long-term debt, 2,24,000. Right? This is all the information that I have it as the JP Morgan Chase. Now I need to complete the data. What are the things? Another information that is given to us. Let's see if any assumptions have been. See, any financial modeling that you do with students, remember one thing, you can't do without making some assumptions. You can't complete it without making some assumptions. Fine. Now let's see what are the assumptions given and then we'll start working. EBITDA, that is earnings before income tax, depreciation and amortization. And we had seen that what has been the growth of this company in the industry, what has been the growth. Now looking at the trend of the industry, we identified that the industry was growing at a rate of 10%. So the similar industry, similar company, if we look at, even if I'm a startup company, but can I definitely look at my peers in the market and get an idea about what could be the probable growth rate? Yes, we can do that, right? So probable growth rate we came to know is 10%. Apart from that, they have given you some information that EBITDA of the company in the year was 200,000. I will write it only as 200. The reason is I'm writing all the data in thousands, right? So I have been given, EBITDA is given for the year 2020 as 200. Then what is accounts receivable in 2021 is 100,000. So whatever information is given, I will just take that information and this information would be provided to me by the management. In which statement will I get to see account receivable? Will I get to see in the balance sheet or the income statement? I have to go to the balance sheet. So balance sheet is below. And if I come here, balance sheet, if I have to look at, I have put it over here on the right hand side. So balance sheet, if I look at, where will I see? How much is the information given to me? They have given to me the information that account receivable is going to be 100,000. So just go to that part where accounts receivable is there and put it as 100 here. Clear? Any other information? Let's check. And accounts payable is given to you as 50,000. Once I fill in the data, then it's easier because this information, if the management is not going to provide to you, you will not be able to do it. 50,000. Fine. Now to answer the question, now all this data has been put, I'm just scrolling. So in the balance sheet for 2020, we have account receivable 100, inventory 60, fixed assets 500, accounts payable 50, equity shares and long-term debt 5,50,000 as per the 5 lakh as per the information provided, 3,36,000 and 2,24,000. I hope we all are together till here. Now, to answer the question that how did we? Yes, accounts receivable and accounts payable. Yes, it is of 2021. 2021. So let me just take this and put it here, 100. And here accounts payable, 50. That all this information is taken. Now, who will give me this information? That I have. Yes, that was a typo. Fine. So only for 2020 in the balance sheet, you have 60 for inventory, fixed assets, 500 and equity and long-term debt. That's all. So we are thinking that yes, this is the balance sheet information that's already given to you, Pratyush. So assuming that it is the financial year starting from the April 1st, we are going to do the forecasting from 21. So income statement is going to be there. Yes, fine. No other information. Only 4 information I put in the balance sheet, which the company gave it to me when the forecasting has to be done for the company. We have filled that data. Accounts receivable, EBITDA is given to you as 200,000. That's the expectation EBITDA that they are expecting for 2021. Any other information? Check. Don't join this session from your phone. You'll not be able to see. So request join from the laptop only. So EBITDA is 200,000 in 2021, which is already given to you. Here you have written down EBITDA as 200,000. Everything is in thousand. Account receivable, you have put 100,000. Accounts payable, you have put. Now, one of you asked why we have taken a growth rate of 10%. Now, just imagine if you are a growing company, right? If you are a growing company and you are just a new company and you don't know what is the growth rate that you can expect. Can you look at your peers in the industry who had been in the industry for a long time and kind of peer comparison can be done? If you look at their growth rate for the last 5 years or 10 years, can you make an assumption that this could be the probable growth of your company in the future? Can we do that? Yes, right? So that is what we have got, the growth rate of 10%. Now, rest of the data is that the company had borrowed 5 lakhs in which they invested 3,36,000 in equity, 2,24,000 in the debt. And from that borrowed capital, fixed asset they purchase for 5 lakhs and working capital for day-to-day expenses, they use 60,000. I hope the problem statement is clear to all of us. Now, what has been the depreciable property value? Only 4,50,000. So when we will calculate the depreciation, we will calculate on 5 lakhs or we'll calculate on 4,50,000. We haven't used any percentage right now. We have just taken the data and put in the 5. We'll calculate on 4.5 lakhs. Now what we want to know that, okay, if the company had borrowed debt and equity from the market at a rate of 15%, one quick question to you all, what is the bare minimum return the company would be looking for in the projects? 15%. Very good. Bare minimum 15 even to break even. More the better. So students, a growth rate 10% is the assumption that we have made based on the past year. My question here is, if the company had borrowed debt and equity from the market at an average rate of 15%, and if they use this money for making investment in the projects, what is the bare minimum return they would be looking at? 15%. Another example I'll give you. Say, for example, I purchased a property by taking a home loan of 8.5%. And I purchased this property for my investment, for my retirement planning. Okay. So tell me, what is a bare minimum appreciation in property I would be looking for? So I took the home loan at 8.5%. So bare minimum, I would look for 8.5%. Same way, if the company has borrowed money and used that money for investment, bare minimum, they will look for 15% return. Absolutely right. So depreciable property is, Pratyush, like the machine or the table or the benches that you're using for your studies. The value falls with the number of years. In the same way, when the company buys a machine, there is a depreciation. The value of it falls with time. Cars, absolutely. When you take insurance, the value of your car falls, right? Every year you will see that IDV, insured declared value, it starts to fall. Laptops, all these are depreciable. Land is not considered to be depreciable, right? Okay, absolutely. One more information. So when you're working as an analyst, financial modeling, when you're doing it, you will have to make some assumptions. Now, the assumption is that EBITDA, your current assets, except the cash, your depreciable assets, which is constant for 20 and 21, and then it will start to increase at 10%. This is the assumption. Long-term debt is constant for 20 and 21, and then it will start to increase at 10%. Okay. Equity borrowing will remain constant. So can we finish off the component which is mentioned here? Equity is constant for all the 3 years. So can we assume that equity will remain the same? So equity will remain 3,36,000 for all the years. So we'll finish off that part which is given to me. Yeah, I freeze the pane so that you are able to see. Okay. 3,36,000 is given constant forever. So I'll put 3,36,000 for all the years. Clear, everyone? Okay, I'll freeze it for all the years. What is the other information given to me? What is the other information given to me? What else is constant that they have spoken about? Tell me, what is other information that has been constant? Anything that's constant? They have said that debt will remain constant for 20 and 21, and then it will start increasing at 10%. Can I finish off that data? Because the management will be able to tell me that how much is the debt that is going to be constant. So in the second year also, it will remain constant to 24, and then it will increase at the rate of 10%. So how much will that be? Can I write 224 into 1 plus 10%? Can I write that? Is that allowed? I can't type 10% all the time. So I'll just go to the Excel and I'll put the growth rate here as 10%. What is the growth rate we have decided? It is going to be 10%. So write down that growth rate. Which column is that? It is D10 for me. So all the time I will write D10 whenever I wanted G. That is what financial modeling is. One of the golden rules, student, is that when you do financial modeling, we don't type numbers, because I may be working on one company, tomorrow I will work on another company. So what we do is we freeze it. We put the values so that next time if the growth rate I want to do for another company is 8%, automatically the data will get changed. Automatically the data will say change, right? So you should always don't type numbers. You should always put it in the input sheet. Input sheet, you should always put the data. Okay. So coming to 2022, I'm just coming is equal to. So what they have mentioned very clearly that 2 years the debt is constant and then debt is going to increase. So 1 plus, what is that column that was? D10. So it will increase at the rate of 10%. I'll freeze this. I will freeze this one. Okay. So I'll freeze it as $D $10. When we write $T $10, that particular cell is constant, right? So that is what we use it in financial modeling, because you might be doing modeling for n number of companies. You will not be changing every time. And if you just drag it, can you see the magic? Can you see magic? Automatically, it has taken that an increase of 10% from the previous year. So in Excel, when you use the modeling, we may do this data right now. I've taken data only for 3 years. Time constraint, 1 hour, financial modeling. So yes, so if you freeze it, automatically, do you see here? Do you see D16 into 1 plus D10? D10 was a cell where I wrote 10% as the growth rate. Okay. Automatically, if you come here, you can see it has taken D10 fix. It has taken D10 as fix. Just see if I don't put D10. Okay. Just see. Okay. I'll show you. If I don't freeze the pane, what happens? This one doesn't have problem. But when I'm dragging it, do you see? It does not. It takes E10. E10, there's no value only. So that's the reason why this is Excel concept, not the finance concept. This says, Excel format says that whenever you want to freeze a row or a column, you need to put the dollar sign. Now, this is the way you use the Excel, right? So we all are till here. Long-term debt is done for all of us. Great. Great. I can see Maximum saying yes. Equity, we already know it's constant. So we have put equity constant. Now I'll go back to the sheet and check that if there's any other information that I have to know. So go back to the sheet and check if there's any other information that I need to. So we'll just have a look and then we'll start working on the same. I'll unfreeze the panes because otherwise I'm not able to see the entire file. Okay. So this we have already, whatever part we'll finish, we'll ignore it. We have taken 2,24,000. We have taken 3,36,000. We have taken 5,60,000. We'll all taken all this information. What is the life of the asset? 10 years. So when you calculate the depreciation, how much on what value you will take? 4,50,000. So when you calculate depreciation, it would be how much? If I'm using straight line method of depreciation, what would be the value? 45,000. So for how much it would be? 45,000. Put that 45,000 for the yes. Put that as 45,000. So is equal to what is the value of the assets? Divide by 4,50,000 divided by 10 you will do. Right? 4,50,000 divided by 10 you will do. Right? So 45,000. Taken information. Then it says the cost of borrowing capital for the company is 15%. So I'll write down here 15% as I'm just trying to write down all the information which is given to me so that it's easy for me to do the data. Right? Yes. 45. Okay. Whatever information is given and expected growth rate, we have written it down. It says EBITDA will grow at 10% every year. Current assets will grow at 10% except cash. Depreciable assets will be constant for 20 and 21 and then increase at 10%. So let's finish off that part. EBITDA is also going to increase at 10%. So can we finish off the EBITDA part? Yes, this will be only 45. The reason is that we are already taking it as 1,000. So this will be only 45. Can I take EBITDA every year? It is going to grow at 10% as per industry standards. Okay. So can I type this into 1 plus? What is that constant cell? What is that constant cell? D10 for me, right? And do I need this constant for my 23 also? So should I freeze it? Should I freeze it? Yes, I will freeze it. Right? EBITDA in operating income was already provided to me from the company, right? That this is an expected that 200 they're going to reach because they've already started their operations and they expect that in 21 this will be an approximate that they would be earning, and beyond that every year the EBITDA will grow by 10%. Every year the EBITDA will grow by 10%. So my EBITDA I can forecast for 21, 22 and 23. For freezing, we just put the dollar sign. That's it, right? This is the company has forecasted that this could be the management has forecasted, the finance team of the company has forecasted that this could be the probable they would be getting it. Okay, right? Now, depreciation, what's the information given to you? That for what is the depreciation information? Check here that depreciation would be constant for depreciable asset is constant for 20 and 21, and then depreciable asset would increase at 10%. I have deleted that. That was just the typo error. No, it is not. It was just typo. By mistake, it got pressed. It's not the operating income, right? So depreciable assets, what should I do? What should I put by increasing by this amount? So can I go and put the depreciable asset is constant for 2 years and then it is increasing? So my depreciable assets, which I have written as 5 lakhs, can I change that? It is constant for 20 and 21 and then it is increasing at 10%. So can I write this into same story? 1 plus D10 I will write. I'm writing the information that's already provided to me and then we will be able to do the forecasting. Check if it's 550 for you as well. And tell me what would be the depreciable assets for the last year? What would be the depreciable asset for the last year? Is it 600 for all of us or 600, exact 600? Okay, 605. Clear? So my fixed assets are done. So fixed Harsh will be calculating depreciation only on the depreciable asset 4,50,000, but my fixed assets will include 50,000 also of the other one. Depreciation will calculate only on 4,50,000, but when I'm writing fixed assets, I will include that both the parts, right? Okay. Now my part is done. Now I'll go back and check the data. And that's why I said, if not Excel sheet, keep the printout. Otherwise, difficult to understand. So it says depreciable assets constant only for 20 and 21, and then it will start at increasing at 10%. And that's the reason why for 20 and 21, we kept it constant and then we have increased it at 10%. Now, student, connection I want to show you here. Fixed asset was constant for 2021. Notice what happened to my debt for 2021. Is it constant? Is my debt constant? That means company is clear that the company will not take the loan. No borrowings has happened. No borrowing has happened. Fixed assets, company did not buy fixed assets. They did not buy land. They did not buy machine. But do you notice in the next year, the borrowings are increasing in the form of debt? Can you see that? So what will happen if the borrowings has increased in the form of debt? What will happen? What will happen if the borrowings has increased in the form of debt? Will the company is planning to grow or expand? It could be something or not. Is the company planning to grow or expand? Yes. So connect the dots. That's the essence of financial modeling. Don't look at financial modeling as maths. It is finance. So when you see here, my fixed assets has been constant. The company did not borrow any money. It was constant. Equity and debt was constant. Now, when the company increased the borrowing in the year 22 and 23, you can also see that fixed assets of the company is also increasing. So they're borrowing the money from the market, using that money to invest in fixed assets. So we are clear till this point. Fine. Now what is the information? Did we miss out anything? No. We have taken all the information. So we've taken EBITDA is growing at 10%. Current assets will grow at 10%. Will come to current assets. Depreciable assets is constant for 20 and 21. And then it will start to increase at 10%. Now if my assets would increase at 10%, they have also mentioned the depreciation would also increase by same percentage as depreciable assets. So how will my depreciation be changing in this case? How would my depreciation be changing in this case? So the first year we had it as, in the first year we have the depreciation as 45. Now what will happen to the depreciation? What would happen to the depreciation now? Will it increase or will it be constant? What will happen? What will happen to depreciation now? Will it change or not? Yes, it will change. Can you see what will be the depreciation now? What will be the depreciation now? It will change at 10%, 22, 23. So it is going to be again depreciation in the last into. Again, I'll do 1 plus D10 because it is given that my assets are growing at 10% and my depreciation would also grow at the same. And I will just drag it so we get it. Check if you get the same. Are we all together till here? Are you able to make sense? Able to make sense? Yes, but very clearly, Harsh, because that small component that is getting added, the small minor changes would be there. But when you're doing it a holistic picture, you will take an aggregate, an average. Understand, financial modeling is not the absolute numbers you look at. It's an average, approximate numbers we want to look at because you couldn't be doing it for each minute details. It's an approximate number to understand what could be the probable value of the company. Fine. Now, can I go ahead and complete my income statement? We'll finish off income statement now because we have taken all the information that the company gave to JP Morgan Chase, and now we are the analyst. We are working on the reporting. So let's see how the reporting is to be done. So operating income, if I want to calculate, can I do EBITDA minus depreciation? Will I get my operating income as 155 or 155,000? Hari Krishna, their fixed assets are growing because the company is expanding. And you can also see that my debt borrowing is increasing. Agar debt borrowing is increasing, my EBITDA is increasing, then definitely the company is borrowing money. The demand for their product is increasing. Fixed assets are increasing. You can see that in the EBITDA also, right? So depreciation, we are assuming that approximately the depreciable assets are increasing at 10%. So approximately, not the accurate method of depreciation, approximately we are doing that what could be the understanding, what would be the probable depreciation. Okay. Operating income is EBITDA minus depreciation. Janvi, you have not frozen the D10 cell. That's why 550 is coming for both 2022 and 2023. Please freeze the cells. Then you will get the right answer. So Aditya, simple funda. My industry sales are growing. My industry profits are growing approximately at 10%. Because see, you will have to make somewhere the assumption. Now that assumption could be an approximate. More detailed, if you are a very seasoned financial modeler, then what we do is we may make changes to different growth rate. But right now, since you are all the fresher and trying to understand, I've taken a flat rate. In the real world, it could depend that I may take a growth rate, maybe 10% for 5 years and then 7% for the next 3 years. So right now, I'm just taking a flat rate. So first you understand how it is to be done. Growth rate calculation comes with the experience, understanding of the macro factors, and not necessarily perpetually the rate would be 10%. But today I have taken EBITDA, first one I have taken that it is growing at 10%. That's why I have taken the assumption that the company fixed assets, the borrowings, the EBITDA, the sales revenue is growing at 10% looking at the industry standards. That's an assumption we have made today. To freeze a cell, you need to use dollar before. Look at this. I have freezed it. Just see this. I have freezed it. $D, $10, right? So you have got this. What is operating income? Operating income is your EBITDA minus the depreciation. You will get your operating income. How did we calculate depreciation here, students? Depreciation was 5 lakh fixed assets, which were depreciable was only 4,50,000. So we did 4,50,000 divided by 10. So basically it is 4,50,000. 450 I have written because it is in thousands already. So I got the depreciation for the first year. Then they said in the assumption, we need to make some assumptions, right? That if the fixed assets are growing at 10%, the assumption is depreciation would also grow approximately at the same rate. Approximately, I say. Now, in the real world, if you go deeper, you calculate it asset-wise and then we do it. But if I'm doing a gross overall understanding of the firm, we may take an approximate numbers. Now here, financial modeling is an approximate value of the company. Anyway, if I'm sitting at 20 and forecasting for 23, do you think what I'm forecasting would be absolutely 100% right, or there could be some changes based on macro factors? There could be some changes. But just understand, students, if I want to make investment in a company, I want to buy a company, I want to sell a company, Do I need to know an approximate what could be the value of that company? Isn't it important? Yes. So some approximations would be done. So don't look at this that how can it be? No, it cannot be. But we need to start somewhere. We need to understand that, okay, growth rate is 10% for 5 years and maybe growth rate will become 12% or growth rate can become 6%. But then it is a maths thing which you will understand as you grow in the career as an equity analyst or as a financial modeling when you do it. Yes. Now, I hope this has made an understanding clear. No, valuation is, and by the way, yes. So can you see we have increased only the depreciable assets by 4. Can you see I've increased only this depreciation and even the depreciable assets. They said that fixed assets are increasing, right? Depreciable assets and then all the assets are increasing at, because that is 50,000 only. Rest all is increasing at 10% approximately. Taken as 10%. Okay. Operating income, is that clear to all of us? Now, can I just drag this and we get the answer for all the years? Can we just drag it and we get it for all the years? Yes. Interest expense at 7%. Now, tell me, company is going to pay interest on which component to the investors? Interest rate on the debt is, right? Interest rate on the debt is how much it is? How much have they given? 7%. So interest rate on debt is given to you as 7%. What does this mean? This means if the company borrows money in the form of debt, the company will pay interest at a rate of 7%. Okay. So how will I calculate that? How much is the borrowed capital in the form of debt? I'll go here, debt. This, how much is the interest they're going to pay on this? So debt multiplied by 7%. How much is the interest component? Check. Is it 15.68%? 15.68 rupees, 7% given. It is given in the column in the income statement, Himani. It is given in the income statement column. So again, the Rashi, where is come? What is the bank home loan going on? What is the bank home loan going on? Do we calculate that? How much is the bank going on? You know that it is around 8.5% approximately. Same way, when the company borrows money in the form of debt based on their credit rating, so approximately the rate is 7%. That is the rate we have taken it up here. That is the rate we have taken it up here. I hope that has answered. Right. Yes, but since I'm writing in thousands, can we write it as 15.68? How to calculate interest expense? How much is my borrowing in the year 21? We'll go there, borrowing in 21. So how much is borrowing in 2021 for long-term debt? 2,24,000, right? How much is the rate of interest on that? 7%. So that same thing we have written here. Same thing we have written here, 2,24,000 into 7%. I didn't want it to type 7% because in the future, the company may change the interest rate of 7%. So I want to just go and select the cell here. The reason is so that in the next 5 years down the lane, if they change the interest rate and I want to do the modeling, I will not start the calculation from the scratch. If I just change the number here, automatically everything will change here. That's the beauty of financial modeling. Clear? Now, interest expense, will it be constant? Yagnesh, the answer is no. Why it wouldn't be constant? Because if you go back to the balance sheet and check, is my debenture amount constant? Is my debenture constant? The answer is no. My debenture is changing. So how will my interest remain constant? Only the interest rate is constant for 3 years that the company has decided. So what can I do? Now, if I have D11, can I freeze D11 with your permission? Because D11, 7% is constant for 2 more years. So can I freeze it? Yes, I can definitely freeze it, right? Enter. And if I just drag it, automatically, if you see, has it taken the debt component for year 2022? Check. Has it taken the debt component for year 2022? It has automatically taken. Now, just for your quick reference, what I'm doing is, yellow one is the data that the company had already given to us as a financial research analyst. So these which I have highlighted in yellow is the data that was already given to me by the company. We didn't do anything on that part because company had given me these data, right? They have given me all this data. I've just worked on that basis because all the things you can't auto-populate. The ones that I put it in yellow is the data that the company always give you, right? Absolutely right, Santosh. And that is where the finding out the growth rate, you may also see that, okay, just imagine next year the budget happens, say, for example, okay, and the company gives you a lot of relaxation on the industry that your company is. Will your forecasting statement change or not change? Maybe the government reduces the tax rate. Government gives you the tax benefit, and instead of 30% makes it 15% tax. It will change. And that is where the beauty is, students, that you always fill the data in the input. The things that we have written here is all input. See, these are all input. The moment I change this interest rate to 8%, check, does my answers change automatically? Check. Is my answers checking? Yes. It's all changing. So that's the reason why whenever you're doing financial modeling, we put the changes in the input sheet. Now I'll go back to my interest rate of 7%. Right, absolutely. So never type the data. That's the thing. Okay, I hope I was just doing this, that we finished all of us at the same level. Now, income before tax. Can I say income before tax as operating income? That is your EBIT minus interest. So Vaishnav, the ones that I put it in yellow box means this was the data given to JP Morgan Chase already by the management of the company. So based on that, based on industry trend, based on understanding the growth rate of the company, we came to an understanding that yes, 10% is the probable growth rate in the market. Fine. So I've got my income before taxes 139.32. Because I need to forecast, I need to find out the value of the company. So we are doing this. Now, can I just drag it and get the answer? The answer is yes. So you just put the first data, and if you click here, you get a plus sign. This is the beauty of Excel. And if you just drag it, you get the answer. If time permits, I will also show you one of more example where you see how these growth rate and everything can be done. Right, if time permits. Okay, now tax at 30%. So can I say, I'll go back here. First, let me check that if I put the tax rate as 30% or not. Tax rate, can I put it here as 30%? So that I'll freeze this again. Because all the time I will not do this. Where is this? D12. I can either come and select it or do it. Tax at 30%. So I'll write this into. Can I come here and select my 30%? Yes. Do I need to freeze it? Tell me. Do I need to freeze the tax rate again? Yes. So what will I do? I'll freeze D12. I'll make it $D, $12. So my tax rate is freezed. I'll drag it. Great. Now my net income is going to be income before tax minus tax. I'll get this. I will just drag it. My income statement is forecasted for the next 3 years. I was provided the data of depreciation. I was provided the information that depreciation is calculated on 4,50,000 for 10 years. Absolutely, Dharmik. You can freeze it multiple ways. My rest, whatever part you see here is the maths part. We just did the maths part and we understood. Yes, absolutely right, Vats. Clear income statement. All of us are ready. We are ready with the income statement. Now, tax rate, Janvi, we'll find out what is the tax rate in the industry. We'll have to find out the tax rate in the industry. Tax, I'll just show here. Yes, Kamya, you can look at how we calculated the tax. Whatever was income before tax, we multiplied that by 30%, right? And income before tax is calculated as EBIT minus interest. EBIT minus interest, you get your EBT. And then if I want to calculate tax, I'll calculate on earnings before tax, 30% if I apply. And then my net income is going to be earnings before tax minus the tax amount that you have calculated. You will get your net income. Now my income statement has been forecasted. Let's look at this income statement. What do you think about this company? EBITDA is growing at 10%, net income is growing at 10%. Considering that the companies in this industry is growing at 10%, do you think it's a more or less a moderately good company to go ahead with? Just based on income statement, what we see, that income is increasing, the net income is increasing, a decent enough. At least it is breaking my bank FD rates, right? Okay. Now what will I do? I'll go to the balance sheet part. I'll finish this income statement. I'm going to the balance sheet. Okay. Now I'll see, yes, it is, I will not say very good company, because there are companies giving you return of 20% or 30%. And over and above that, let me tell you students, 10% is a very relative term. Maybe I'm a risk taker and for me 30% is a good return. For some 10% is a good return. So it's a very relative term. So depending upon how much is your risk appetite, we decide the returns. IPOs, people make investment and they earn a lot of money, but a lot of risk is involved. So it's a very relative term. We can't say that this is the number that everybody should look for. Does it depend upon our risk appetite? How much of risk can I take and so on? Yes, absolutely. Which industry you're coming from, which company you're making investment, what kind of investor you are. A lot of factors are involved, right? Okay. Now, what is the information given to me? I will take that information and then go ahead further. The company has said that current assets will grow at the rate of 10% except cash. Anyway, cash will be my balancing figure. So can we finish off this exercise where my accounts receivable will grow at the rate of 10%. So this will become into 1 plus D10. That is my frozen cell. So I'm just going to freeze it. So I can see that the company accounts receivable is increasing. Now tell me one thing, is accounts receivable increasing good or bad? What is your understanding? If my accounts receivable is increasing, my sales is increasing and my accounts receivable is increasing, then what it is? Good or bad? My sales is increasing and my accounts receivable is increasing, and it's a good sign that yes, I have to get goods on credit, right? My inventory is also increasing. Good or bad? My inventory is also increasing. It is good. That means yes. I'm making D10 because I know that is my cell. Otherwise, you can go and select the cell. I'm just filling in the data. By now, my expectation is you all are experts in creating this. I've just done 10%. Yeah, modeling, analysis of the company, there is a qualitative aspect, there is a quantitative aspect. So only financial statements does not tell you anything. Only the qualitative data does not tell you anything. We need to look at the mix of the data to understand that how good or bad is the company. So inventory, they haven't mentioned if it's constant or not. So we'll take it as increasing at 10%. Cash, we can't take it because that will become a balancing figure. Okay. Then can I come to accumulated depreciation? So where will I take this data from? I'll take this data from where? Have I already calculated the depreciation? Have I already calculated the depreciation? Yes, I've already calculated the depreciation. So can I take the data from there? The answer is yes, I'll take this data. They're asking for accumulated depreciation. So I'll take this year plus this. Accumulated, how much is the value of the depreciation? So I'll take the data from profit and loss statement, and then they're asking for accumulated. So I'll take the previous year data also. Here I'll take the previous year data plus the depreciation. I'll wait here till the time you're there. Okay, now I'll just take the value from here. Later on we'll do that. I've just taken the data from the depreciation here, 54 point. Just the data you take it from. Just take the data, the depreciation from there. Fixed assets less the accumulated depreciation to get the real value of the assets. Done? That's okay. Let's take the depreciation because we want to anyways look at each year how much it would be. Just take the depreciation on the asset. 45 for the first year, 49.5 for the second year, and 54.45 for the third year. Where have we taken this data from? The income statement, where you've already calculated the depreciation on the asset. Yes, you've just taken from the income statement, nothing else. Just from the income statement. Done. Why are we doing fixed assets minus depreciation? What is the logic? Do I want to understand the real value of the assets after depreciation? Is that the reason for me to do it? What is the reason for me to do it? I want to understand the real value of the asset. That's the reason why I'm doing it, right? Okay. Now what else can I do? What should I do now? Can I do any other calculation? Tell me. What else can I do in this? Current assets is done. Anything else? Current liabilities, can I do it? Accounts payable, can I do anything? How much is the information given for accounts payable? Accounts payable, how much have this said? Is it increasing at the same 10%? Yes, this is the information. So into 1 plus D10 because I know that is a cell where the growth rate is there. Should I freeze it? Yes, I'll do $D, $10 and I'll just freeze, dry. 60.5. Done. Nothing else. I finish accounts payable. I know equity shares. I know everything. My balance sheet, any information which is left is only cash. Cash, we are going to fill it later. Why will we fill it later, guys? Tell me, why will we fill it later? Why will I fill later? Why did I say we'll fill later? The cash component. Why? Because that would be my balancing figure. So I leave that amount. Okay, I'll come down and see which other information is pending. I finished all. Retained earnings. Can I take the net profit, assuming no dividend was paid by the company? Can I take the net profit from here and that would become my retained earnings? And I'll just drag it. Okay, now this is my profit. Will my retained earnings will be whatever is the retained earnings of the previous year plus whatever is this year, because no profits are paid. So will that get added or not added? Say for example, in the first year, I got a net income of 97.5, but the company did not distribute it, it kept with itself. Next year, another profit of 107 came. Will it get added or not get added? What will it happen? It will get added or not get added? Because I already had, so that's why you will take it. Yes, you will take that and add. Will it be 204? Check once. Is it 204? Check. And for the last year also, I will take whatever is the previous year and plus whatever is the net profit made in this year. Okay, let me tell you, Nidhi, you had 10 rupees. Next year, you saved another 20 rupees. What will happen to Nidhi's money? What will happen to Nidhi's money? You had 10 rupees. Next year, you made 20 rupees. So 30 rupees. Third year, you saved 50 rupees. Then what will happen, Nidhi? 80 rupees. So the first year, the company made profits and it was 97.5. So next year, will this amount get added to the next year profit or not? The company is keeping that money, right? So it will get added. The reserves and surplus. Students, is my working capital spent from my reserves and surplus? Working capital, day-to-day expenses, do I spend from my reserves and surplus? Generally, no. So your working capital would be taken care of by other things. Retained earnings, the profit you have made will get retained the next year, and next year. Okay. Now, does my assets and liabilities of the balance sheet tally or not? Should it tally? And let us see how much is the total liabilities of the company. For the first year, it is 657. Okay, I've taken only liabilities. Okay, forgot the current liabilities. I forgot the current liabilities. So how much will this be? Current liabilities plus this, plus this, plus this. 707, check. Yeah, so I've taken all my liabilities. Is it 707? Check. Done. Should it tally my balance sheet? Yes. So what will I come here? How much should be my total value of the assets also? Same amount it should be. 707.24. Isn't it? So tell me what would be the liabilities. Jishnu, you will add all the numbers. Accounts payable, that is current liabilities. So basically you're using the sum formula. You are doing the sum of all the liabilities. That's it. Right? Now, if total liabilities is 707, how much should be the total assets? 707. So tell me what is the balancing figure? What will be my balancing figure here? Cash amount, how much it should be? How much should be my cash? 707 should be there. Minus all this amount should be equal to, should I plus depreciation? Because minus of minus will become plus. Retained earning is Lalit. Is retained earning part of your equity borrowing? Yes or no? Is retained earnings a part of equity or not? Yes, no, right? I have to find out my cash, which is my balancing figure. How should I do that? Go ahead. No. How much is that cash amount? Liabilities minus all the assets. How much is that? Check. Do liabilities minus all the assets. How much is that? So can I do the cash component if I want to find out? I will do this account receivable plus inventory plus fixed assets minus this, right? I missed something. Tell me what is that? What should I do? I have to subtract from 707, right? Minus, I should do all these components. Should I get the same? Will I get my balancing figure? Total, my 707 should be my total assets of the company. Take away all the other components. You should get your balancing figure, right? My assets should be equal to my liabilities. That is how we make the balance sheet, right? So you will subtract from the total assets or total liabilities, subtract all other components. That's why I put the bracket. So you will get the cash amount. First year it is 86.52. Let me know if you are there. Done? Can I just drag it and automatically my answer will come? So, Shashank, you know all the values. You know your total should be 707. So, how would you find out? You'll do 707 minus all of them, minus accumulated depreciation it is. So, minus of anything is what? Okay, I will fix the liabilities. Total assets. Can I do the same exercise for all the other years? Can I do the same exercise for all the other years? So this you have calculated. I will just drag this and get my total sum. Check for next year. How much did you get? Balance sheet mein. These numbers there for the second and the third year. Check. 842 and 990. Is it there? Yes. Okay. So now my total assets also should be the same. Agreed. So can I get my cash as the balancing figure for the other years? Same story. This is my balancing figure. So I can write down very much all the time. The cash is going to be my balancing figure in forecasting. So I know the company's cash is increasing. Now let me show you some finance analysis in this, guys. If you see that the cash of the company is increasing, okay, and if the company still goes to the market and borrows money, you think all the time will it be looked as a positive sign? No. So do we need to be careful that if the depends exactly, but all the time it will not be good sign, right? Now, why somebody is asking why my total assets and my total liability should be same? Should balance sheet tally or not? Because whatever funding you're borrowing, Vanita, you need to show the application of that fund also in the current assets and in the fixed assets. Otherwise, the company, you want to know, no? Actually, if you have used money for borrowing, you have to show that, okay, this money was used to buy the inventory, it was used to buy the current assets, it was used to, current liabilities, it was used to buy the fixed assets. That's the reason the balance sheet has to tally. If it doesn't, then there is a mistake, right? So this, my balance sheet has to tally. So we have taken the amount of total liabilities, that is 707. We put it here and then it has to tally, you know, all the component except cash. I've just taken. So total liabilities minus the accounts payable, minus the inventory, minus fixed assets, minus the accumulated depreciation. So you get the real value of the asset. Then you get the cash component. Okay? This is how we get the cash component, right? Now I want to quickly show you something. So my balance sheet, I've got it. My income statement, we have got it. Absolutely right, Swaraj. You're absolutely right. Now, quickly, I want to show you one thing and show that, okay, how do the valuations can be done for a growth rate that you were talking about. Let me show you. This is the part which you can do it. But say, for example, I'll show you the data in the same. So I just put the data here, okay? See this. This is the another analysis that I was doing. So say, for example, this is a company already listed and already performing, and still I want to make an forecasted data for this company. Okay, see here that the financial year, past financials are given to you of the sales in this sector. They've given that the sales have been approximately at 18, 17 and 19%. Now, you know that this particular industry is going to do good. So you can forecast on an approximate basis. How do you do that approximation is, you see that how much is the industry growing in the future. Okay, you see that, okay, just after COVID, the industry was falling and then it improved. And now you know that, again, it is going to grow approximately. This is an example of an automobile. Yes, Anindita, this sheet is not for working. This is just to show you so that now maths part, you know, the working part of creating the balance sheet and income statement, you know. But how to get that G, I want to tell you that, because that's again very, very important, right? So you can see that approximately that sector will grow at a rate of 8%. So if you know the data, if you see here, you've taken that sector will grow approximately at 8%. So you will take that, okay, your company would also approximately grow at that rate. Approximate, not the accurate. Okay? This is for an automobile, Hero Moto, right? Can you see that Hero Moto growth market share is 27%? It's a good company. You also see that, okay, everything, you look at EBITDA margin also. So you look at the past data of the EBITDA and you see that, okay, what has been the approximate growth rate of the company in the last years? And you see that, okay, approximately, if you look at this data, students, just see this data. What do you approximately will take as a growth rate of the company in the near future? Approximate. you will take 11 to 12%, right? This is how we do it. Now, the example that we took, say for example, it's a startup company. Can I take my peers in the market and take that data? Can I look at my peers in the market and take that data? Absolutely. And that is what we have taken here as 10%. Now, the question is that we have taken 10% flat for all the numbers was to make it easy, or just to make it easy for us to understand. Here, if you see, we may take the sales at something else. We can take the, say, for example, the EBITDA at different rates. So you look at the past historical data of your peers in the market, or if you have already established company, you will look at your past historical data, you will compare it with the industry trends, and then we take out the data and then we put the values, right? So PAT margin also, if you look at this number, you will take an approximate somewhere around 8%. If you look at this PAT margin based on past historical data of your own company or your peers in the market, what would you take? What would you do in this case? Approximately 8%, 8% you will take the data and start working on that data, right? This is how it is done. So you look at PAT as profit after tax. The net profit that we calculated. Remember in this sheet, we calculated the net profit. If you see the last May net income, that is nothing but the PAT, profit after tax. Clear? Now you're able to understand why I took 10%, because otherwise this 1 hour would not have been enough for us to do it. It would have taken long time to, and somebody was asking how long a model takes. Trust me, students, not less than 7 to 8 hours. So I will say 1 full or 2 full working days it takes. The reason is we go deep into the economy, try to understand how is the economy doing. We try to understand how is this industry growing. Then we go to the company details and do it, right? So this is how, this is just the introduction. 1 hour financial modeling, just the introduction we have done today, where we have seen that, okay, if the approximate growth rate of the company is given, can I forecast my income statement and balance sheet? That is what I've shown it to you. And I hope that was, you could understand to a certain extent that how it could be. And students, to master in Excel is very important if you want to grow in financial modeling or be an equity research analyst, do the forecasting of the statements. So this is not the end. You try to understand, okay, what's the value of the company? What could be the price per share? A lot of things goes into it. This was a very simple day exercise where I gave you, TK, everything is constant at 10%. You know, not actually is going to be 10% for perpetual. I have forecasted for only 3 years. When the company sets, it may forecast for 10 years. I want to buy a company. I'll do forecasting for 10 years, trying to understand that 10 years down the lane, will the company make sense to me or not, right? It wouldn't be constant. So that is why it can happen that you take 10% for 3 years and maybe then you take 8% depending upon the, can I say even the macro factors changes would have an impact on your assumptions. Nobody expected COVID, right? COVID came, there was changes. Do you think the models would have changed at that time? The answer is yes, right? So a lot of things. This was just a very, very basic trying to make you understand in 1 hour. This is something that we do it in the industry. There's a lot of art and science involved in doing the modeling. So this was just the introduction that I could share with you all, right? So if I think in the meantime, when I was taking the session also, I've answered many of the questions, right? So I hope it was useful and gives you an understanding how it could be done in the market, real world, when you work as an equity research analyst. All right. Thank you so much.
Thank you, ma'am. Okay. Thank you, ma'am, for such an insightful session on financial modeling. I'm sure everyone found this session incredibly valuable and has equipped our students with valuable tools to enhance their financial acumen. Students, thank you for attending and we look forward to see you at future sessions. Lastly, those who have attended the session more than 1 hour will get the e-certificate on your mailbox within 10 to 15 working days. Okay?
Yeah.
I guess you have answered almost all the questions, ma'am. So thank you so much.
Good night and take care. Thank you.
Bye-bye.